Imagine finding out you've been leaving thousands of pounds on the table every year because of simple ISA mistakes. That's reality for a lot of people watching this video right now. ISAs are like financial superpowers that let your money grow tax-free. But like Spider-Man learning to use his abilities, most of us are still shooting webs in our own faces rather than swinging gracefully through the stock market. I mean, look, ISAs are one of the best tools we have to grow our money tax-free. But loads of people, yes, probably even you, are making mistakes that could cost you thousands in the long run. And the worst part, most of these mistakes are totally avoidable. So today we're going to run through some of the biggest ISA mistakes, why they matter, and how to fix them before it's too late. So let's get into it. Now, one of the biggest problems is probably the most widespread across the country, and this comes in two parts. First is that a huge amount of people in this country opt for a cash ISA over a stocks and shares ISA, often because it's seen as safer and more familiar because they don't want to risk their money on stocks as it seems complicated. And don't get me wrong, cash ISAs are a really helpful tool, but not for the long term if you want to grow your money. Over the past decade, according to Money Facts, the average term for stocks and shares ISA has been approximately 9.64%, while cash ISAs have returned around 1.21% on average per year. This highlights something called opportunity cost. While cash ISAs may seem safer, you're actually missing out on 8.43% per year on your money, which is huge. It might not seem like much, but if you were saving £200 per month over 30 years, that would be a staggering £301,000 difference to your savings. And while that's a problem, it isn't the only one, because when you add in inflation here, how things become more expensive and your money becomes worth less, it's been 2.5% over the past 20 years. Well, good news for the stocks and shares one, but it's bad news for your cash ISAs. So while people think they are safe, they're actually losing out to inflation and losing out even more when you compare it to stocks. This is why people are massively missing out if they're using cash ISAs for long-term savings. And this is why encouraging more people to switch from cash ISAs to the stocks and shares one could be a good thing. Now, second to this is people delaying contributions. So what if I asked you, would you rather have £100,000 or £250,000? Because that's the difference between investing early and waiting. The number one thing I hear day in, day out is, I wish I started sooner. And I often think about why this is, and it's because either A, they didn't know about investing, or B, they wanted to wait until they felt like they were in a good position to be able to afford to invest. And this is a huge mistake. The earlier you start in your investment journey can significantly reduce the monthly contributions needed to achieve the financial goals. This table shows the required monthly contributions to reach £500,000 by age 68, assuming a 7% annual return. Whereas an 18-year-old would only need to contribute £100 per month, someone who's 50 would need to put in £1,188 to get the same end figure. This is where we kick our 18-year-old selves and say, invest. But when we're young, you really don't look at it like that. And it's what we really need to show the younger generation. And here's the numbers to hit £250,000 invested, which essentially cuts those numbers in half. You can make this easier by taking advantage of government bonuses, but remember, anything is better than nothing. So understanding how adding on a regular basis can grow over time is crucial. If you achieved an average annual return of 7%, as we'd hope with a well-diversified index fund, here's how much you could have invested by the number of years invested. 5 down to 30 down the side, and 200, 300, 400, and 500 per month. This chart is a really good indication as it's something you can use to easily work out yourself what you could expect to get. If you invest more or less, you can just double or halve these numbers to find your end number. Of course, take these numbers with a pinch of salt, nothing is guaranteed. But the truth is, when you uncover how investing works, it's time that's your best friend, rather than how much you're investing. If you look at any compound investment returns chart like this one, you'll see this upward trajectory. With you contributing the same amount, it's the interest you gain that rockets rather than how much you add. So the sooner you start, the better, because at the end of your investment journey is when you will make the most money. Now, if I told you you could have more money by not using a stocks and shares ISA, you would probably think I was having you on. But before you rush and put your money into a stocks and shares ISA, you take a step back and decide if it's really the right type of account. A lot of people get this wrong, and I don't blame them as it is very confusing. But if you look at the optimal order to invest, the first thing you want to do is maximize your workplace pension, because even if that gets worse returns than you would like, your employer has to contribute a minimum of 3%, which is huge, and you'll end up with more in the end. And needless to say, pay off any high interest debts. But it's the money that's left over after that you want to save, you really have to think about. The first thing that really throws people off is the lifetime ISA. You can only put in £4,000 per year into this account, but you get up to a £1,000 bonus added tax-free, 25% by the government. But you only have the option to open one before age 40. This is almost too good to not take advantage of. If you want a house, the lifetime ISA could be a no-brainer. That's extra money towards a house. Annoyingly, this doesn't work if the property currently exceeds the price of £450,000. That limit was set in 2017 and house prices have skyrocketed since then. So for example, if a buyer in London stayed for years only to realise £450,000 wasn't enough to buy their first house, they would then withdraw and be faced with a 25% penalty, wiping out a chunk of their savings. A lot of people in certain areas in the country are having problems with this and are facing this silly penalty. It might seem like you're just getting your bonus back, but you're effectively getting penalised 6.25% on your money, which you shouldn't have to pay when withdrawing. It's also not very clear when people sign up. They think it's 25% gained and 25% taken back, when effectively the way percentages work, it doesn't work out that way. So that's where the 6.25% comes from. However, it tends not to be this one that catches people out, as most people think it's a go-to account for a house. It's actually the question of whether you should use a lifetime ISA towards retirement or not. A lot of people don't realise here that even if they've used one for a house, they can have another one open towards retirement. The account is weird though. You can only contribute until age 50, and it's essentially frozen for 10 years until 60 when you can access it. But in those 10 years, you can just focus on investing into something else. People get really put off by the access age more than anything. But that's £1,000 per year tax-free. If you got that £1,000 for free each year with 7% interest over 20 years, that would grow to £46,000 for free off the government, which you really want to take advantage of, which isn't something they're going to give you very often. I see it as well, that's going to be a pretty nice chunk of change when I get to age 60, so you might as well take it. If you are over 40 though, don't worry, because the difference is very close between this and the next mistake which most people overlook, which is a pension or SIP. Now, I will hold my hands up and say here, I definitely made this mistake, thinking that the ISA is better than the SIP. And the truth is, it's really not, at least financially. I made a really in-depth video explaining this, which I'll link to at the end of the video, but here's a quick explainer. If you were to invest £1,000 a month at 7% return, here's how much you would end up with in an ISA and a SIP. Because you get that 25% bonus back, or 20%, whichever way you look at the tax, you're ending up with £131,000 better off between the two accounts. If you're a higher rate taxpayer, it's even more of a no-brainer because you get a 40% relief, which is a £262,000 difference. The amount of people paying high rate tax who don't know about this is really crazy. Now, the difference between the SIP and the ISA is really tax, but when you factor that in, you'll essentially be paying 20% income tax and you get that 25% tax-free lump sum. Even paying that tax as a basic rate taxpayer, you're £32,570 better off. And if you're in a higher rate, you're a whopping £163,000 better off. The thing I think a lot of people hesitate on is the access age, which is going up to 58, and the government could honestly move the goalposts even further. But the best way, I think, to look at it is this. Well, you're going to need money from 58 onwards, so get that number right in the SIP. Then, if you get money in an ISA, you can essentially buy years before that you can use to retire early, so it's a win-win. You really should take advantage of the SIP over the ISA. ISAs are fantastic, don't get me wrong, but the SIP will get you more money in the end. And it's why I changed my goal from being an ISA millionaire to a SIP and ISA millionaire combined. It's money you just can't leave on the table. But speaking of something you might not be able to move around is access, and this is mistake number 4. So here's the question. If you withdraw money from your ISA, can you put it back in? Well, the answer is, it depends. If your ISA is flexible, you can withdraw and replace the money within the same tax year without it affecting your allowance. But with a non-flexible ISA, that allowance is gone forever. A subscriber messaged me saying they withdrew £5,000 from the ISA to cover an unexpected expense, thinking they could put it back later. But it turns out their provider didn't allow flexible withdrawals, so they lost that tax-free allowance forever. To fix this, you should always check if your ISA is flexible before you withdraw. Otherwise, consider using an emergency fund instead if replenishing your allowance is important to you. In my recent ISA comparison, I mentioned all of the providers that do offer one. A really good option is the one from Lightyear, who I'm proud to say are the sponsor of today's video. Lightyear is making waves in the investing scene with the launch of its new ISA. Lightyear is an FCA authorized broker who's created a really sleek investing app that really stands out on both mobile and desktop. They've over 5,000 stocks, ETFs, and money market funds. The ISA is flexible, which means you can easily move money in and out, which is huge. And there's no execution or custody fees on ETFs from them. And best of all, you can earn 4.61% through their Vault product, but keep in mind this is an investment product, and like all investments, they carry risk. When I first heard about Lightyear a few years ago, I was really excited because it looked so promising. Their extra stock and fund details and analysis really stood out. I'd definitely recommend looking at the app and giving them a go, and you can get $15 worth of a free fractional US share when you sign up using the link in the description, or you can add code Chris in your promotions section. But please remember, investing involves risk and your investments can go down as well as up. Number 5 is something we all hate talking about, but it's super important that you're aware that it exists. When someone with an ISA passes away on or after the 3rd of December 2014, their spouse or civil partner can inherit their ISA allowance using something called an APS, or an additional permitted subscription. But a shocking number of people don't realize that this exists. This allowance is separate from the standard annual ISA limit, and it allows a survivor to contribute an equal amount to the value of the partner's ISA at the time of death. The APS is also separate from inheriting actual ISA assets. You can use the allowance even if you don't inherit the funds. For example, if your late partner had £50,000 in ISAs, you could contribute up to £70,000 into ISAs this tax year, including your standard £20,000 allowance. So let's say a couple had £80,000 in an ISA. When one of them passed away, the surviving partner might have thought they had to cash it out, missing out on future tax-free growth. Now, in reality, they could have transferred it over and continued it growing tax-free. So it's horrible to think about, but if your partner has passed away, make sure you claim the APS. At least it keeps their ISA benefits after they're gone. Now, a bit more positive, but speaking of something that's gone, is the ability to only have one ISA open per tax year. Hooray! Or maybe not. This mistake is something that's been made worse recently by the government themselves. Up until recently, you could only have one ISA per tax year, which did cause some problems. But now you can open as many as you like, which is great for trying out new platforms and exploring options, but it's not so great for your ISA limit. So, can you put more than £20,000 into an ISA in one tax year? Technically, no, but some people will still do it accidentally because it's much easier now. You might not notice, but HMRC will definitely notice. You would imagine before allowing such a rule, HMRC would build a government portal where you could easily track how much you've contributed from each ISA. After all, it's linked to your national insurance number and it shouldn't be all that difficult to do, but no. Unfortunately, you need to track it yourself. If you know you've gone over within the tax year, you can contact the ISA provider and ask them to refund the money back into your account to help keep you on track. But even if you do that, or if your provider allows you to do that, I would recommend contacting HMRC. They have an ISA helpline and try and get some advice and explain what's happened. If you're unsure, I'd recommend just speaking to them for some advice. They'll have the data to hand, and it's really best not to just ignore it, as there'll definitely be some kind of tax penalty or charge for it down the line. So try and keep track of your contributions, especially if you're using multiple providers, even if it's just on a basic spreadsheet, or stick to one ISA as much as possible. I know it's hard now with different ISAs, the lifetime ISA and stocks and shares one, and having multiple accounts open, but if you're getting close to the £20,000 limit, you want to double check before making that last deposit. Now, the last mistake is something I see wrong in pretty much every portfolio that I look at, and it's something to do with how much you're paying. Now, this comes again in two parts. The first is you want to make sure you're not overpaying for the platform you are on. Using a low-cost platform will make a huge difference. Things to look out for are things like trading fees, platform fees, and high foreign exchange fees. One will usually outweigh the other, and you won't realize until it's too late. I would check out my best ISA comparison for the year if you want to see these side by side. But second, which is usually a really easy fix, is the investments themselves. The truth is that although your investments probably look low cost, you could be overpaying in fees. For example, one of the most popular funds, the Vanguard All World Fund, charges a fee of 0.22%, which on the surface seems pretty low. But if you were to follow my Vanguard 2 fund strategy with pretty much identical holdings, you'll pay 0.13%. And that's presuming you have a low-cost one like the All World Fund. A lot of people have much higher fee funds, especially with things like thematic funds which focus on a specific sector like AI. Now that might not seem like much, it's a difference of 0.9%, but if we look at how that adds up over time using a fee calculator, if you invested £500 per month and averaged an 8% return 10% over 30 years, that would cost you £15,000. And if you add things in like a 0.25% platform fee, which some charge, that's £60,000. So before you know it, those unexpected fees, although they might seem like super low cost, 0.25% is actually costing you tens of thousands of pounds. So double check what you're paying. And one thing I will add in here, the amount of people I speak to that've got a financial advisor or someone who set all of this up for them are paying astronomical fees that they don't even realize. So try and look at the fees through all their documents, which probably are way overcomplicated. Work out what they're charging you, because I bet it's way more than you would ever imagine. But if you are making these mistakes, don't worry. I made over £200,000 worth of mistakes, believe it or not. Investing isn't easy, but it's all about trial and error to rectify these mistakes to quickly maximize your profits. What I'm trying to do here is share all the mistakes I've made so you don't have to make them too. If you haven't, do consider subscribing, because I'd really like to have you on my journey here, where I document my journey right up to this £1 million goal. But before you go, if you want to make sure you've got the right account, I would check out this video, or if you want some more information on the SIPP versus the ISA, which could be your most expensive investing decision, check out this video too. Thanks for watching, and I'll catch you guys over there.